All right, so within working capital management, we're talking about the need to have cash in time to pay debts as they become due. So firms need to manage cash so that they have enough money to pay debts as they become due. Current assets need to be liquid enough to pay debts as they become due. We know working capital as current assets minus current liabilities. The goal is to maximize shareholder wealth. You can't keep everything in cash, but you got to have enough cash to take care of those short-term debts when they become due. Otherwise, you wind up insolvent and forced into bankruptcy because you can't pay those debts as they become due. They call that equitable insolvency in bankruptcy. So we don't want to keep too much cash, but we got to have enough. So on slide 3, we know how to calculate working capital, current assets minus current liabilities. And the more current assets and the less current liabilities, the more working capital we have. The more working capital we have, the less risk of not paying debts as they become due, because the company would have enough current assets to meet those obligations. The higher the working capital, the less risk of not meeting those current obligations. But the goal is not to just keep everything in cash. The goal is to balance profitability and that risk of not being able to pay the debts. So if a company has too much cash, they have a low risk of not meeting loan payments when due, but at the same time, they may get a low rate of return because they're not generating a lot of revenue from the cash that they have in the bank, right? The alternative is to buy a lot of long-term assets and open a lot of stores where you need a lot of PP&E. More risk, though, because now you don't have cash to pay off debt. More risk, but higher return on assets, because the stores that you open with the cash that you're spending is going to generate a higher return than the cash that you leave in the bank, that you leave behind to pay off those current liabilities. So we call this working capital management on slide 5. And we need to balance it. And it's up to management, because all management teams will have a different approach. Some may be more conservative and some may be more aggressive. Conservative working capital management has a high amount of current assets, more working capital, and a higher current ratio. And that's considered more conservative because less chance of getting caught with debts maturing, and you won't have the cash. There's less of a chance of that if you're conservative with your working capital management. But on the other hand, if you're aggressive with working capital management, you don't have enough current assets. You got maybe too much current liabilities because you opened up a lot of stores and you have a lot of current liabilities associated with that. You don't have enough current assets because you spent the cash opening the stores. You're more aggressive, and aggressive working capital means lower current ratio. Conservative working capital means higher current ratio. You follow? But current ratio isn't everything, right? Current ratio isn't everything when it comes to a business. Current ratio just means the bigger the numerator here on slide 6, the more conservative, but the less likely that you get caught with debts maturing where you wouldn't have the cash to pay it off. So the current ratio we know is the current assets divided by current liabilities, and this goes hand in hand with working capital. Working capital is current assets minus current liabilities. Current ratio is the same thing expressed in the form of a ratio, current assets divided by current liabilities. And the bigger the numerator, the more conservative, but the less return. So higher current ratio is better in terms of risk. Current ratio is a good indicator of a firm's ability to pay short-term debt as it becomes due, but it's not really a good indicator of profitability or future cash flows because you're leaving all this cash behind and you're not growing. So on slide 7, during year 2, bridge companies' current assets increased by 8,000, current liabilities decreased by 9,000, and as a result, net working capital did what? Now the way you would, we know that current assets minus current liabilities equals working capital, right? Therefore, what's good for current assets is good for working capital. So if current assets goes up, working capital goes up, right? So if current assets goes up by 8,000, working capital is going up by 8. Now, if what's good for current assets is good for working capital, and current assets and current liabilities are opposites, then what's good for current liabilities is bad for working capital, right? So if current liabilities were to go up, that would be bad for working capital. But they didn't go up. It says current liabilities went down by 9. So that's actually good for working capital, isn't it? Because if current liabilities fall, working capital goes up, because if current assets don't change and current liabilities just falls by 9,000, that's good for working capital, because what's good for current liabilities is bad for working capital. So what's bad for current liabilities is good for working capital. So you have an increase of 17,000. So here's a new one. During year 6, Orban Company's current assets decreased by 40,000. Is that good for working capital or bad? Bad. And current liabilities decreased by 15. That's actually good for working capital when current liabilities go down. But that big drop in current assets is going to drag working capital down. Even though the decrease in current liabilities is going to help, you're still going to be decreasing working capital by 25. Because that big drop in current assets means real bad news for working capital. And the current liability decrease is going to help working capital, but not enough to offset that big drag in current asset decline. So you wind up with a decrease of 25, letter B. You can look at the answer on 10. But it's the same thing that we said. Current assets have a direct relationship with working capital. Current liabilities have an inverse relationship with working capital. What's good for current liabilities is bad for working capital. See, working capital, assuming you want it to be positive, which you do, what's good for current liabilities is bad for working capital. So if current liabilities keep going up, then working capital will eventually be negative. You don't want to see current liabilities be greater than current assets. You never want to see that, because then you have debts coming due and you don't have enough current assets to take care of it. Business isn't going to last too long if debts are coming due and you don't have current assets to take care of it. So you want positive working capital. And as current liabilities keep increasing, if they do, then they're putting a lot of pressure on your working capital. You wind up with a negative working capital, and that's a sign that the company might belong in bankruptcy. Here we have a net decrease of 25,000, and that you don't want that to continue. So a good analysis here would be you would not want that to continue, because eventually the working capital could go negative overall. This is just the change. We don't know what the totals are. We don't want to have a negative working capital. Let's go to 11, where it talks about a deteriorating current ratio. A decline in the current ratio means a decline in working capital. And that implies a reduced ability to generate the cash needed to pay off debt. It could be as a result of an increase in short-term debt. Current liabilities went up. That's why working capital went down. Or it could be a decrease in current assets. You spent a lot of cash. Or a combination of the two. You could have just a decrease in current assets, and that's why the current ratio and working capital went down. Or you could have an increase in current liabilities, and that could be why the current ratio and working capital went down. So when we talk about the current ratio and we talk about working capital, they are the same thing. One is expressed in terms of a ratio, current assets divided by current liabilities. And one is expressed in the form of an equation, current assets minus current liabilities. But it's the same situation for the company. If they have a deteriorating current ratio, they have a deteriorating working capital position. If they have an improving current ratio, they have an improving working capital. Here's a good analysis question. You ready for this? So if you sell an asset for less than book value, that's a loss. So you have a decrease in net income. That's a loss because you sold an asset for less than book value. Proceeds compared to book value would be gain or loss. And if the proceeds were less than book value, that's a loss. Now, how does that affect working capital? Well, you sold the asset, so cash is coming in which case you've turned a non-current asset into a current asset. You've now increased your current assets without increasing current liabilities at all. So you have improved your current ratio. You have improved your working capital as a result of getting some cash, or maybe you got a receivable out of this. Maybe both. Maybe you got some cash and some receivable. So you've got increases in current assets and no increases in current liabilities. So you've improved working capital here. Letter B is the answer. Now in 14, an increase or improvement in the current ratio or an improvement in working capital implies an increased ability to pay off current liabilities. And that might be attributed to using long-term borrowing to pay off short-term debt in cases where a firm lacks cash to pay off debt. So let's say you have debts coming due and you don't have the cash to pay it off. What are your options? Here's debts that are coming due. You could try to borrow again, or you could try to pay it off. And if you don't have the cash to pay it off, then you got to borrow again. If you borrow again short term, is that going to change or improve your current ratio? No, you're just trading one short-term debt for another short-term debt. You pay off bank number one with a loan from bank number two, but you still owe bank number two. And if it's a short-term debt, it's going to be included in your calculation of working capital because it remained as a short-term liability. It's just a different bank. So paying off short-term debt with new short-term debt is not going to help you. But paying off short-term debt with long-term debt, think about what that would do. So you have a note coming due in 6 months and you just negotiated a 5-year loan with a bank and they're going to give you cash enough to pay off that short-term loan that's due in 6 months. You've just taken a current liability off your balance sheet. You know what that does to your working capital? You've just improved it because you got rid of short-term liability and replaced it with long-term debt. Your overall debt doesn't change, but your current liabilities just went down, and that's what's included in working capital. It's the current liabilities that we want to get rid of for an improvement in working capital or an improvement in the current ratio. We want to get rid of those current liabilities. So 15, which one of the following would increase the working capital of a firm? What would be an improvement in working capital or current ratio? How about B, cash payment of accounts payable? Hey, we're paying off debt. We're paying off short-term debt. We're paying off short-term debt here in letter B. Yeah, but we're using cash to do it. So we're reducing current assets and we're reducing current liabilities at the same time. That's not going to help working capital. That's going to leave working capital right where it was because current assets just went down by 1 and current liabilities just went down by 1. So they're both still going to have a working capital, the same relationship. So if current assets were 10 and current liabilities were 10, and you just paid off with cash a $1 short-term loan, current assets have just become 9 and current liabilities have just become 9. So you went from 10 minus 10 to 9 minus 9. You haven't improved anything, right? But what if you would have paid off that short-term loan with a long-term loan? Look at A. refinancing of accounts payable with a 2-year note. Now you're reducing current liabilities without reducing current assets. You've just improved your working capital because current assets are still 10, but current liabilities are now 9. You just improved your working capital, right? Assuming we started out current assets and current liabilities with 10, letter A reduces current liabilities from 10 down to 9, but it doesn't change current assets. They're still 10. So you wind up with improving the working capital, but not in letter B, because in letter B you would bring both of them down. Cash goes down, that's current assets going down. Accounts payable goes down, that's current liabilities going down. There's no improvement in working capital there. How about C? So far we like A. We want to improve working capital. We want to see when working capital would improve. How about C? Payment of a 30-year mortgage. You're paying off a 30-year loan with cash. You're taking cash right now and paying off a 30-year loan. Well, that's going to decrease working capital because cash is going to go down by 1. But current liabilities aren't going to go down at all if you pay off a 30-year mortgage. That's long-term debt. So current assets will go down by 1 to 9, but current liabilities will still be 10. That's a decrease in working capital, not an increase. How about D, cash collection of accounts receivable? That's an improvement in cash. Right, you've just traded one current asset for another. That's not going to help the overall working capital. So the answer is only A is going to improve working capital. Hey, it's Darius. Go to CPAExam-Tutoring.com and get what my students have dubbed the BEC Video Bundle, where I break up all of BEC into 5 separate sections. Section 1 of the BEC Video Bundle has corporate governance and economics. Just this section alone will add 10 to 20 points to your BEC score. Then go to Section 2, cost and managerial accounting. All your favorites there, like process costing, job order costing, even variance analysis, budgeting. And then it's on to Section 3, which is financial management and ratios, net present value, internal rate of return. And then to Section 4, which is all IT. And IT is growing in importance on the exam. If you ask me, I think one day the CPA exam is going to have an IT exam as one of the 4 parts, but we're down the road for that. So Section 4 is IT. And then Section 5 is all simulations, where I narrate and explain a whole bunch of simulations on different topics. So you could buy the BEC Video Bundle in different sections if you just want one section of it, or you could take advantage and buy it all, the entire complete BEC Video Bundle, with one click. Here you can get the complete BEC Video Bundle, all 5 sections, for 40 days. Now this offer will expire August 1st, 2018, but there'll be another offer there where you can buy the whole BEC Video Bundle with one click and go to CPAExam-Tutoring.com. Get all the videos you need to pass BEC, but don't just take my word for it. Go ahead and look up these people on LinkedIn, get in touch with them and ask them how they were able to pass the CPA exam and what their experience was with my videos or my one-on-one tutoring sessions. And they'll let you know, just like they are here. You can reach out to any one of these people or all of them